Okay, folks, welcome to Market Trends. I'm David Russell, VP of Market Intelligence at TradeStation. Hope everyone is having a great week as we draw near the end of May, Memorial Day. I want to just zip through some disclosures really quickly. As usual, before we even start that, let me just show you, if you could, to go to TradeStation.com, go to Research and then Insights, and you will see the blog post, the Wall Street sign. That is the rundown for our webinar today. And if you want to follow, we're going to be covering points here. Let me just quickly show you some disclosures as we're doing that. It's a very interesting environment, kind of the best of times and maybe the worst of times, or maybe not. If you're in a worried mood, then it could be the worst of times, and if not, then it seems that we're in a process, though, of a spreading awareness, slow and steady, that as long as we don't blow up the debt situation, there are just so many positives building in the market. And I think that after NVIDIA, it's hard to look past that. I would just say very quickly, as an idea, there's the whole thing in the history of technology or media. And I think of, what I read about the 1960 presidential election. There was a debate between Kennedy and Nixon, and the people who watched Nixon, who listened to Nixon on the radio, thought Nixon won, and the people who saw it on TV thought Kennedy won. And a lot of media historians have looked at that as a turning point of when the visual power of television really became evident, and it created the world of television as we know it, or it was a major milestone. And I say that because I think when you look at AI, and 10 years from now, when everyone has AI, this and that, or even a year or two from now, when AI is such a huge theme in the market, we could look back to May 24th, May 25th of 2023, and say NVIDIA's guidance, the same way that people looked back at Henry Blodgett's big call on Amazon. Was it Amazon or Yahoo? Back in the 90s, I don't even remember. Henry Blodgett made this big, bold call on either Yahoo or Amazon, saying it was going to double or something. And people thought he was crazy, and then it happened. And people then look back and say that was when the dot-com boom started, or something like that. And but anyway, when you look at the big picture here, I think this NVIDIA thing, it was insane. 50% above Wall Street estimates on revenue. So this is a spot now where I want to actually return to a theme that I've mentioned before, just very quickly. If you just Google FactSet earnings insight, you will find something that FactSet creates once a week. The last one would have been last Friday, but I have it right here. Now, I've been talking about this for a while, and I archive these. I just download them every week. This is what you have here. And just so you know, I'm jumping now to page 5. All right. For calendar 2023, analysts predict earnings growth of 1%. Now, a month and a half ago, 2 months ago, it was 1.5%. Okay, now, here's the key picture that I think, and I said this last week, but I have to repeat it after NVIDIA. Does anyone really think that when you have an earnings season that was way better than feared for Q1, and now we have NVIDIA completely annihilating any remaining bearishness toward tech, do we really think that for the full year this number doesn't have to go up? I mean, just when you think about it at this point in time. So the fact is, right now, we had certain people, especially the gentleman at Morgan Stanley, saying earnings recession. Okay, but then look at the reality now. So I think we just have to realize is that if we don't have a horrendous run on banks, if we don't have a recession, right, these earnings numbers, I mean, there's a chance they're going to be higher. And I think that that's something that as we move forward, that awareness is going to remain. And we also see, or it's going to spread. I would say it's going to spread. And the other thing is that we're going to be in a situation where, it's funny. The numbers, the news coming out from the Fed in the last week. Let's go to my rundown here before I just go through this really quickly. What did I say? Positives build amid debt ceiling weight. All right, so the only thing to me was, if you look at the Fed on the 19th, we had Powell talking. He said, I'm afraid of doing too much in terms of raising rates. Fed minutes see less certain needs as we're waiting for past tightening to have its effect. Okay, so if you look at the CME, futures countdown to the Fed thing, let's just look in the last week. All right. So at one point in time, people were thinking, oh no, maybe they're going to hike. There was a certain idea. Where are we now? See, so for a certain time, where are we now? This had migrated. See, they're kind of even now. It's interesting. But if we look further out in time, the key thing is, let's just see how much it's changed. See, today it's shifting back in that direction, probably because of the good GDP report. But the key thing is that the Fed's messaging is much less like aggressively hawkish. And I think the market, people keep saying, oh, no, the market's not listening to the Fed. But if you actually look, in my view, if you look in what the Fed has said, and the other thing is, yesterday we had Waller, saying, we need to wait for the next set of data. So the key thing here is the Fed is actually starting to give signals that, they're starting to be more clear. This is not wishful thinking anymore. So the thing is Christopher Waller, who's another new guy, he said we have to wait for the next set of data. So the thing I keep kind of emphasizing, as we look at the calendar, and I should have added it here to upcoming events, it's only the next week, but the real thing is as we look out into the month of into June, we have that huge sort of set of events in the second full week of June, where on June 13th, we're going to have CPI, and on June 14th, we're going to have the Fed meeting. So that's like the big set of everything. And we're going to also have, we're going to have non-farm payrolls next week. We are going to get, the following week, we're going to get, start getting more of the actual, monthly economic data that will have some impact, especially we have payrolls, I think. I'm sorry, yeah. Next Friday we have payrolls for the month. So that's going to be important. Look at the payrolls. We're going to look at the wage inflation. But then we get to that spot really in mid-June. And we're going to start to really see CPI, and then the Fed meeting, which is going to have the dot plot and the forward projection. So in my mind, we have all that kind of pointing in that direction. And when you look at the earnings being good, and then the economic data, it's just a widening sort of drumbeat of positive things, as long as we don't have some kind of bad ending with this debt ceiling situation. One of the things I actually thought was kind of interesting, I'll just add, and I added this actually to the economic news. It's very interesting if you look at the S&P. This is like a PMI survey. It's a private sector survey. I have it right here from Standard & Poor's. If you go to this flash composite, there was actually something in my rundown here. It was very interesting. Was that input costs dropped for the first time in 3 years. And then we say too many inventories weighing on manufacturing. Okay, so we are back now at a spot where we have a deflationary situation. Lead times and delivery times, all those things are completely back to pre-COVID conditions. The first fall in input prices for the first time in 3 years. Price pressures across the private sector diverged. So look at this. My point in all of this is, whereas we're in a moment now where Fed funds is above CPI, and the data keeps confirming downside in inflation, and people keep saying the Fed's going to keep hiking, even though the Fed is actually starting to really be more, or I should say less clear. They're being more ambiguous. So very interesting. Another quote. Let's see a look at this thing from Rick Reeder. This guy is a big shot at BlackRock, and he says the economy's in much better shape than people think. And this guy manages, I don't know, like $1 trillion. Anyway, BlackRock, massive. He is their chief fixed income guy. So you're talking about a pretty interesting, observation here, and we've been saying this all along. The American economy is going through something that people don't understand, and it's very positive. And so we have the economic data that is not bad. Anyways, you put these things all together. This was an interesting article. You want to look at this BlackRock chief bond reader. Look, this is an article that I thought was kind of interesting. That shows that this narrative I have and what I've had is recession doesn't make any sense to expect. It's just that people's models are wrong. We've entered a new kind of economic, situation of jobs reshoring and all that, which I've said many times. But we just keep getting more confirmation of it, which is why I wanted to emphasize it. This situation is setting up for low inflation, economic growth, rising incomes, and likely a reflation of equity valuations in the coming quarters. So looking at the S&P 500, there's a range here between 40.50 and like 40.87, maybe like 41.87, maybe 41.90. But if you look right around the middle of that range, let's take a look here on TradeStation. So this is a little chart I was working with. Let me just actually create a new one so I have a clean chart. Well, here's something very interesting to me. Let's look at the S&P, SPX. Let's go to a monthly. Let's do something monthly here. It's kind of interesting. Now, I just find this interesting. Let's go to drawing Fibonacci price retracement lines. Okay, and let's go from the low to the high. Now let's look at this. And we see the 50% of today of the monthly range. Let's just get this. The key point is we're holding the middle of this monthly range. Why is this not working? So the middle of this monthly range is, we can now go, it changes like a daily, so you can then see it on the daily. Wait a second. Did something funny with it. Anyway, the midpoint of this range, I'm messing around with the thing because I have another chart that I don't share with you guys. 41.31. It's just my own personal chart, which is a mess of things. 41.31 is the middle of the range. Let's look on the daily now. 41.31. Right here. Right there. So yesterday, we had a false breakdown under it, came back. Look at this also, this candle here. Both of these are similar to what you would call a kicker candlestick. That's when the market pounds lower and you close near the lows and you feel like you want to go home and shoot yourself in the head. And then the next day, everything's wonderful again. And in many ways, that's what we've seen here. The kicker is when it goes down and then it immediately like explodes back. It's a pretty interesting pattern. And what's interesting is to see how much when we came back from that, we went to the high. And in this case here, same thing, we beat down and then it's like all those negative thoughts you had are suddenly wrong and it reverses the other way. So from my perspective here, what's very interesting is 4100 is now emerging. I'll be honest, I thought we were going to slam down to 4050. That was a monthly range that we have on today's rundown. This range here. And but when you look at the way we've come back like today, and the price action today, to me, this is pretty interesting that we went down near 4100 and we didn't even get there. And so now it's pretty interesting to kind of see that. So 4100 could be emerging as the new kind of support level here. It was a level that we hit. What's interesting here is let's look at this on a weekly. I always like to flip around and see these things because when you look on the weekly, you can see 4100 was a weekly close. And now you kind of have this false breakdown under last week's low. So this to me tells me that we're in that same situation of there's just no sellers. And I think that remains the narrative when we look back on this, and we'll say, why did the market rally, in 2023? And we'll say because there were no more sellers. And then on top of that, we got good news. But right now, this market is not even reacting to good news. It is simply not reacting to an absence of bad news. They're not reacting to bad news that doesn't exist. There's people keep expecting we're gonna have that next wallop of horrible news. We have been beaten by COVID, and then inflation, and then war in Ukraine, and then blah blah blah. For the last 3 years, we've just been shell shocked, and we keep thinking there's going to be another horrible thing to happen, and it doesn't happen. And then it's just this quiet, you know, move of money back into stock. So if you look at the AAII sentiment index, I have it here somewhere, but I can just reopen it. AAII. We see this again where the money remains at extremely low levels of historic bullishness. And it's just been kind of, under 30%. It wasn't that low in the period coming out of, 1994, 95. So to me, all this looks like a similar situation. Is that I've been saying that all along, and it continues to play out. That was, inflation, Fed hikes, soft landing, breakout. And now I have there's a long-term chart I have here that I keep on my other. Let me just show you. This is a chart I look at like every day or two, and I kind of, I look at every week at least to make sure I keep this one on TradingView because I use it on multiple computers. Sometimes when I'm working on my own home computer, I want to see it. All right, so there's a series of candles here that I've been just watching how we basically have been holding. The key point to this is we were holding the midpoint of this level, and we did, and we held it again, in fact, this week, which is really interesting. This is the midpoint of this big outside range that we had at the beginning of May. We basically have now held the midpoint of it, which was right here at 4117. So it's all around the same thing. Excuse me. Now, let's look way back in history because I did this thing on this chart way back here in the 1990s. Very interesting here is this is when the Fed, this is 94 through 95. This is when the Fed, started hiking. We had a year and a half of just hating life. And if you look at this time, the AII sentiment, if you actually go and look at this, and you can download it if you want, go back and find the old spreadsheet. It was basically in the low 30s in that period. And then what's really interesting is when we broke out, look at how tight this was. And this is what happens when you come out of a period of consolidation where all the selling is done and all of the old, assumptions are wiped out, and like a whole new world emerges coming out of that. And, it's always that idea that we have a new leadership coming out of a bear market. And people say, well, coming out of this bear, and I've said it myself, coming out of this bear market, we're going to be led by industrials and financials, right? And it sounds wonderful. But in some way, and then you say, well, why are we now going back to the same growth stocks? But the thing is, what happens if they're not the same growth stocks? The old growth stocks were e-commerce, and they were communications and internet, and the new growth stocks are AI. So if you look at these things here, it's kind of like it's two different kinds of growth investing. One, you had the cloud migration is what drove the previous boom, and the e-commerce that drove the previous boom. But the next boom, and there were previous booms that were caused by the spread of mobile and everything else. This is a different iteration of the boom, and AI is another stage. It's another chapter in what we very well could look back on in 50 years and say that was the great growth boom that had multiple stages, and we're entering a new stage right now, and we have been for the last few weeks or months, and that is AI, and it could continue for several years. And I think that's kind of where the market is. That's what we're now realizing as we sit here after that NVIDIA number. Okay, so where's my rundown? So when I wrote this last night, honestly, I hate politics, and I'm hoping this will be over soon. But there were a few things I saw that were, it wasn't clear to me the whole thing of, oh, they're going home for the holidays, and that sounds really bad. And then there's these things about the Democrats being like really, both sides are, the Democrats are being more intransigent and the conservative Republicans are, and it just looks like more and more of this sort of problem. But then when you actually look, there's this growing idea that they're going to ram something through. It's probably going to be some kind of mutant thing, like a Frankenstein package of cutting this and not cutting that. But it sounds like they're inching towards something here. And there have been multiple articles now that I've kind of seen this. I want to point out two of the things that were interesting, though. JP Morgan said there was a 25% chance. Oh, let it go. It was here somewhere. JP Morgan, I lost it. They said there was a 25% chance the United States was going to default, or at least have a technical default, or have to prioritize payments or something. And then we also had Fitch coming out and saying that and putting the United States AAA rating on watch negative. So sometimes that's what you need to end something. It's kind of like when the headline actually hits, then the story is over, and maybe that's where we are. So my point in all of this is just to emphasize that there is apparently some really significant positives building beneath the surface, and we have a market here that has really not moved for if we look here, we really have not gone anywhere for about like a year and a half. Back here to, about a year, the market's really been going sideways for like a year. There's a weekly chart, and there's just as things build on here, there's going to be the odds of a breakout just keep increasing. I think we just have to keep our eye on that big picture and realize that if we really are entering a period like this, back here, and in my view, it seems increasingly likely that this is actually what's going to happen. And we could be looking back in 2 years at a market that's a lot higher, and like if the things pan out the way I've said, inflation coming down, and and earnings catching up, and there being no recession, all those things together, and each of those separate stories are seem to be coming together. All right, so we didn't even get down to the 50-day moving average. I wrote this yesterday, and I thought there'd be more, kind of weakness in chopping, and then we have this incrementally positive news today from Washington. So as we look out, one thing I think that's really interesting is there is a narrative that we're going to have a quote unquote liquidity drain of, because the Treasury hasn't been issuing bonds and all that sort of stuff. And it's been driving up, and there's going to be a flood of Treasury issuance when they, pass the debt ceiling increase. And then the market, that's going to be a drain on equities. And it could be, but what I think is interesting is that real rates are getting to a spot now where they are increasingly sort of, interest rates are positive in real terms, with inflation, likely coming down. And we could be at a spot here where in a few weeks, when this whole thing is over and done with, where we see the top in bond yields. And when that's the case, the reason I point this out is, as you guys know, I have said that, the housing industry, I think, is in a very interesting spot. And they've been pulling back recently, the ITB, the housing index. Kind of interesting to see it holding this old high here. But I think it's interesting just to kind of have, some awareness here of the housing sector. It remains in a spot that is, very positive. And, it's interesting to see it at the bottom of that Keltner channel, isn't it? But to me, this is an area where when you look beyond AI, these guys really just own, they have a huge chunk of something that has to be done. There's going to be a lot of home construction. And, if rates do peak in the next, few weeks, and we get through this whole process, we could see a significant boom in home building, and home buying. So I think this sector needs to remain on people's radar. I think when you look at it, it's very interesting, man. I was just watching that. I can't believe how well we're holding up here in this. When you see mortgage yields, rates continue to move higher, but housing, I think, needs to be on our radar. for this year. We shouldn't be just obsessed with nothing but technology. The one other thing about housing is it's technically a consumer discretionary, and most consumer discretionaries have done poorly recently when you go away from like, Tesla or I mean Amazon and Tesla, but retailers have been really struggling. There's a little bit of problem with that, but I think ultimately the home builders are in a spot where they have tremendous relative strength on a year-to-date basis. Let's go to MT Main. Let's look at our industries on a year-to-date basis. And we can actually see here that, the home builders were number one, and now with semiconductors just thrashing them. I mean, it's incredible. Look at this. These guys all leading here, but home builders do remain on the list. They've pulled back. You can see here they're in their 1 month range. They're lower in their 1 month range. That's what this tells us. So this is actually a spot now where I didn't even thought about it, but at this point, it's actually getting to an area where people might start to be thinking it's time to be looking back at these. So kind of interesting to be noticing this. This is what I love about this workspace. You can go through and you can just really quickly see, and this is how we want to use it. We want to be looking at stuff over a longer time frame, like 3 months, 63 days. We say, all right, what's strong? And then in that frame, what's weak? And gold miners have gotten thrashed, and I think that's not necessarily an interesting entry here. But what I think is interesting about gold miners, they really tell us that people really don't see the Armageddon scenario hitting. That false breakout in gold miners, it hasn't worked out for them, and I think it's we're not seeing that kind of end of world story come together. But when you look at this on a kind of trailing basis here, I'm just looking down how some of these any opportunities for names that have pulled back. I mean, the home builders here kind of pop out as best. So let me go through some of my other points here I want to make. New home sales strong in April. I mean, these numbers, I'm not sure how much they even matter. The real thing that matters is the fact that there's just a shortage of inventory. Let's actually look, because a lot of these leadership things have been kind of shifting. If we look in the last week here, we can see really semiconductors and the kind of tech area have really been strong. And then if we look down here, retailers weak. What's interesting to me, I want to actually mention is the Chinese tech stocks. We were talking about this a while back, and this area I believe is remaining in just liquidation mode. I think China is. I've mentioned this. I think these Chinese stocks are in big trouble, and it doesn't seem to me that there's a lot of ways that they're going to come out of this in a good spot, because politicians are going to beat up on China, but ultimately the problem with China is their own country. I mean, they have a lot of debt, they have bad demographics, and they have a government that is not particularly fond of business. And I think that China will never recover from what Xi did to these tech stocks about a year and a half ago, when he started cracking down on a bunch of business stuff. I think that he really damaged sentiment in a way that it's going to be hard to see really recover. So I think that this is a case of the party's over in that, in my view. So we had actually done on TradingView this idea about Alibaba, which I thought was kind of interesting, because here's a name that had a lot of good news and it just couldn't hold itself together, and now it's setting up the bearish descending triangle. And my view, this kind of fits into this, but from my perspective, some of these Chinese names, they have just the momentum is a long-term sort of breaking to the downside here. I mean, this thing consolidated. It hasn't gone anywhere for a year. I mean, it fell, it consolidated for a year. Here it is back at the level from May of last year. From my perspective, this is something where, let's fire up Option Station Pro a little bit here and actually think about this. Because the nice thing about Baba is Baba has a lot of options activity, and that can be interesting. So I'm sorry, the new application, Option Station Pro. Let's look at Baba. So people looking at Baba here might be looking for, a move back down to the 52-week low. Excuse me. All right, so move towards 60. Let's take a look at like the end of September. It's a nice kind of quarterly mark that puts something like the 60-65 put spread, the 65-60. So these puts would cost $2.11 and they would bring in $1.20. So you're looking at a spread here that would cost under $1, so that's the sort of thing from my perspective that some people might be looking toward, because this, when you look at it, it's the momentum is really difficult. And so this is sort of thing that, kind of interesting to me. You think about over time, things like this when they're bleeding lower. Some ways you can think about using options with, set it and forget it and see, or something like the 70-65, a spread like that, 340 versus 203 is like $1.40 for a $5 wide spread. You can also go here to spread, go to vertical, and then you want to go to let's see, strike range. Apply that. Let's see. You can actually see how much these spreads would actually cost. It's $1.36. So some ways to kind of think about it in terms of using options when you can target kind of long-term levels. All right. So besides the NVIDIA news, it was pretty interesting to see the Palo Alto Networks and the cybersecurity narrative just remains a very strong, thing in the market right now. Some of the other names, to look at are FTNT. That's an interesting one. I'm pretty sure they had some interesting earnings. That's an interesting one that just now pops up on the radar. And then the other one that was interesting was Applied Networks had decent numbers, and then they pulled back because it ran on good news, and then it ran on hope. They sold their they bought the rumor, sold the news, it pulled back, and then continued. So it's kind of interesting. But I want to show you some of these signal scans. A lot of these popped up in my signal scan. So what we did was we were basically using, for most of this, we use MA tools, and which is now all of these, remember, are in the workspace I've given you guys if you don't actually know. Actually, I see a question there. I'm going to give this to you. If you go to, I just Google here. I think I can grab this. Try this, Craig. Anyway, all right. So when we use this, it shows us, just different pullbacks to moving averages. It's very simple, but it can be a very effective sort of way of doing things. And so yesterday, for example, a bunch of these stocks were actually popping up for me. So yesterday, for example, one of those was Oracle. I mean, it was amazing when I looked at this yesterday. This chart was just kind of perfect. I couldn't believe how perfect it was. It was this pullback, to that exponential moving average, pull back to the old high. It was hanging right in there. So it's pretty interesting to see this kind of price action. That was one that popped up yesterday. Another one that popped up was Apple was holding its 21-day exponential moving average. Shopify was another name that had been, as a kind of just pull back to the moving average. And then the one, to me, honestly, when I look at some of these, I think we have to be careful because there has been weakness in consumer discretionary, and Shopify is not an AI play, and it's not really a tech stock. When you really look at it, it's an e-commerce name. This has not really been a favorite of mine, but it did pop up, and it is interesting to kind of see how it at least bounced at the 21-day exponential. Micron is another one that had, I mean, we did an idea for this one on TradingView, and if you actually look at TradingView here, the ones that we do, Wait a second, that's the wrong thing. Sorry, we did this idea on TradingView, and this was to me a really interesting one. Honestly, I set a price alert on this one at this old high around 64.34, and we never even got it. I mean, I was hoping, I mean, look, we got down to 64.70 roughly, and then we never even got lower. This is pretty interesting. Look how they defended this low yesterday. I mean, it couldn't even get down to that old that old high. So I mean, to me, Micron here, they want a name like Micron is. This thing is just like a it's a freight train when it moves. Sometimes it falls off the track. It often falls off the track, but when it gets on the track and it starts moving, this thing can really move. And it can move in like straight lines like this. And this was nothing compared to historically what this thing had done. I mean, look at this thing coming out of, yeah, this was a great run in Micron. I remember this was just incredible. Anyway, Micron to me is here. It's really interesting to kind of see this broad strength. And the thing about Micron is it's kind of like a bellwether that sends the overall direction of the semiconductor market. And they basically said things are going from bad to not so bad. And that's all anyone needed to hear. It had this rally here on a bad earnings report, held, and then after that breakout, that was it. So to me, this was a really interesting one to see in Micron, and then today is giving you no pullbacks. All right, so Cemex. Now, this is a stock a lot of people might not know about, but it's actually been just a tremendous performer. You know, with all the infrastructure build and everything else. What's interesting is Mexico is the top performing non-US market this year, at least that I track. And Cemex is a cement company, but it's been a real outperformer. It has a lot of high ratings. I think this was a big upgrade this day. I think I'm going to Morgan Stanley, but it popped up because it held the bottom of the Keltner channel. So I wanted to kind of you know, flag that. I have a scan that finds stuff when it pulls back to the Keltner channels. Another one actually that popped up in my list on the pullbacks of the 50-day was MasterCard. This is interesting here. I think let's kind of see if this thing holds. It's, you know, MasterCard and Visa are both kind of like boring sort of names, but they are, they can just be just steady movers based on the overall market and the overall indexes. And, you know, from my perspective, names like this here, if you want to look at it just on risk reward, you have now pretty close to like, you know, you're seeing these higher lows. You have a second day here right at this 364, 365 level. And what's interesting is, well, first of all, it's a bullish outside day, but it's also a false breakdown. So, you know, under this low, it went under and it didn't, and it held. This is now a sort of thing where, you know, 365 could be a risk management level. And now you could be in a spot where a name like MasterCard here, let's take a look at the options on this one. Because in my perspective here, what kind of what do we have to the upside of like a call spread and a name like this? You know, a move to like 385 to 390. You know, for when's the next earnings? Next earnings are gonna be the end of July, estimated. Not that doesn't match up that closely, but I'm just interested here in seeing like what kind of opportunities might exist in something like this. You know, move back to 390 or kind of 395, you know, there's some potential opportunities here. But, you know, from my perspective, a name like this, the thing you have is you have the risk management of this low here. And if you take out this low, you can walk away. But the thing is that otherwise you have a name that is, you know, on a weekly, if we look at it on a weekly basis, I mean, that's a daily chart with a lot of action on it. Let's look at weekly here. MasterCard weekly. You know, it is at a spot where this could be near the end of a long consolidation phase. This stock, if you look at it, is a long-term growth stock. It's had these periods of consolidation before. You know, if you were to look at some of these phases down here, they probably don't look that different than this does. So I think it's just kind of interesting if you look at this period here. If you look at some of these other periods, it goes through a period of consolidation. and then it breaks out, and then it has a run. So I want to just kind of point that out. I mean, this has been a very steady growth name over, you know, the last many years. Okay, so my kind of mover of the day is SYM. Now, this company is a robotics company, and if you look at their website, it's, pretty interesting because they are doing kind of AI for warehouses and for e-commerce. They have these robots that manage inventory and stuff. So, from what I can tell, they have, robotic solutions that tie into your software that you use for managing your orders and stuff. And it's kind of like a turnkey solution for people. So that's the sort of thing that's kind of interesting. And I would say they had a good earnings report back here in May. The stock kind of, had already run, chopped around, and now it's continuing new highs. This name and SMCI, which I've talked about as well, these are the kind of names that we might look back in 10 years. And I mean, I just find it interesting to look back at like where Cisco and Microsoft were in like 1991, 92, and to see how high they went. And I think the thing is that some of these are names now, Supermicro, another AI computing name. These are the sort of names that people might be looking at and saying, like, where are they going to be in 5 years? And I think now, as we're getting, to the spot where the Fed is near the end of its cycle, volatility remains low. This is the point now when people, I think, can, with some degree of seriousness, think in 3 to 5 years and really think long-term growth investing. And some of these are some names that I think are showing their hand now. And if you look back at what Cisco or Oracle or Microsoft looked like in the early 90s, they looked like this, but they were on a split adjusted basis, a few cents. And so I think that's some of the names that are popping up now. And like I said, I think this AI thing is a fairly, it's a strong trend that is not it's not just fantasy. It's not fluff. Upcoming events. I mean, honestly, I don't think a lot of these matter when I really look at it. For me, the main thing really here is going to be, well, Salesforce could be interesting. That actually could be. We had actually, written a lot about this bullish triangle breakout, which actually worked pretty nicely. We had an article here on Market Trends about it, on Market Insights. We did a thing about Salesforce. I think if you look here at sectors, technology, this one had a lot of call buying. We wrote about it at the time, and it had this triangle breakout and continued higher since. But another name, I mean, this is just another stock, kind of like it's like last week we were talking about ServiceNow. I mean, boom. Anyway, I mean, this name, had good earnings. They instituted a stock buyback, broke out, pulled back. Then this NVIDIA thing. Remember, these guys have a partnership with NVIDIA, so that's kind of interesting. But that's ServiceNow. But Salesforce earnings next week, is one of these names that, I mean, from my perspective, this is one now that also sets up for more of a binary options play. Something like this, without a good report could get hammered. But that's the sort of thing where people might be thinking, you know what, with an earnings report with Friday of next week. All right, so we have it's on Wednesday of next week. We could say, all right, let's take a look here to the upside. If you think, oh my God, this thing could be awesome, and it could, it could go back, to like up here or something. And, that is not unreasonable. Look at this gap down right here in this day. I mean, a move to 240 in a name like this, if you believe that this tech boom is real, and something like let's take a look at the call spread of like a 230 next week options on CRM, the June seconds. Something like the kind of, let's just go to straight. The one thing to be careful of is you're never really sure what kind of strikes they have. In this case, these guys have $2.50 wide spreads. So when you set the number of the width of your spread, it's often good to start with single first on your options express on your options Station Pro thing here, because then you can see how wide. In this case, it's not $5 or 2.5, but from my perspective, a move like the kind of 230 to 235, it costs like 220, and it brings in $1.40. So you're looking at a spread that's going to be like an 80-cent spread for a $5 wide, spread, 80-cent cost, vertical. Let's set this now to strike width. Let's set it 2 strikes. That's how you control that. Now it's going to be 5. So something like a move here, 230 to 235, a spread like that costs 77 cents. And if it does go to that level, if it goes to 235, which is right like there, that would be worth $5, and it costs 77 cents. So that's a way to manage risk. It has like a 6-to-1 risk reward. And if you believe, wow, this one's going to have another crazy sort of reaction. And I mean, Salesforce it's in the Dow. They're not like just a random stock, and they've been delivering. And these guys are talking about doing AI stuff as well. They're talking about using all kinds of. Remember, these guys do most of the promotional email that you're going to get from anybody, including TradeStation. It goes through Salesforce. And as and these guys are doing stuff now with AI, in terms of better targeting people and a lot of other stuff they're going to roll out across their entire service. I mean, I can just imagine it. They're going to have something where you don't have to have people writing your emails, and they're going to be optimizing them, and they'll be writing emails all with AI. That's the sort of thing that a company like this could do. And again, these guys are right in the thick of business. They don't need to invent a new business or a new vertical. They're already there. So it's not that hard to just start cranking out new products and services that hit your existing customer base, which means they have high margins. You don't have to add new customers, and you add new products to existing customers. It's nirvana, because you don't have a lot of cost of acquisition, and you're basically getting the margin boost of a new product without the margin drag of adding new customers. So to me, Salesforce here remains a name that we should be thinking about as we look out to next week. But beyond that, we have this debt thing and this debt ceiling, and we have anything kind of leading up to the Fed. So I think right here, the thing I'm just kind of watching is if the S&P manages to hold 4,100, I think that's really the main thing. It's going to be hard to know anything much beyond that. From a risk management perspective, if something does go bad with with what's happening in Washington, one way to think about managing that is with some out of the money kind of puts with a high sort of Vega. All right, so the VIX here, and I have this on this chart. All right, wait a second. That is the wrong chart. This one. All right, so see the VIX coming up. It's interesting to see the VIX under 20 here. So the thing is if we actually are going in a bad spot in terms of a default, say things really do look like they're going to really hit the fan, it's going to be, you're going to see it in the VIX. So there's a few ways to think about it. One thing is, if you look at something like, like SPY, one idea, and I'll say one thing to me that is, tricky about, you can use something like a put spread and say, all right, the SPY here held 410 yesterday. So, say we shoot toward a default, maybe we go back down to this low. So, people can think about something like, a 405, kind of, something like a move down to like the 404s, something like that is a potential. And those put spreads exist. My concern with those is we could see a slam down and then a recovery. And you could have a spread that, the problem with the spread is that if it doesn't expire at your levels, then basically it doesn't, it doesn't expand to the full value. So you need something where it's going to expire essentially with the price going through your levels. So, we could see something when like McCarthy says no deal, and then like they stomp out of the room, and then like 2 hours later they stomp back and everything's wonderful. The market could tank for a few hours and then the next day explode higher. Something like that could happen. So from my perspective, one way to manage that is a different kind of thing. And this is something that I have done from time to time, and it actually makes a lot of sense now. So we want to look here at single, and we want to look way out in time. Let's go to all. This is something that actually can make a lot of sense when you really use the options Greeks to your favor. So longer dated options have a higher vega, which means they're more susceptible to spikes in volatility. So one thing people can do is, say, for example, we looked out to something like January of next year. If you look at some of these puts that are down at something like even like the 300 level or something, you'll see how these puts is every dollar the VIX goes up, these things will go up 48 cents because of that vega. But if you look at the delta, they have barely any delta. So what does this mean? It means that the S&P jumps 100, so the S&P jumps 100 points, and we break out to new highs, you're not going to lose very much money because they're not very sensitive to direction. But if the S&P crashes, they're not going to inflate very much based on the movement. But they are going. But if the S&P crashes and we get a volatility bounce, then you're going to basically see that's where they're going to inflate based on the VIX going higher. So every point the VIX moves up, these gain. So say the VIX goes from 18 to a 40, boom, it pops up, it goes up 20 points. Something like this, these puts could go up, potentially $7, $8, $10. And that would be, and then if the market rallies, they're not going to lose very much money either. So it's insurance, not trading. I think right now betting to the downside to me now doesn't make very much sense, because I don't think there's anything very negative in the market. However, if you want a true hedge, this is one approach that I've learned from some people who I used to work with. And I wanted to just kind of mention that. All right, let me just see if I have any other notes I want to cover. What is interesting is, it's fascinating. The Saudi oil minister came out 2 days ago and he said, "Uh-oh, better be careful if you're short oil. We're going to hammer you at the next OPEC minister. It's not the ministerial meeting; it's like the non-ministerial meeting on June 4th. We're going to hammer you, and we're going to hurt you. And then the Russians come out today and say, we're not on board with that. We're not going to cut production. So what's interesting now is OPEC, and this is just when you think about it, the Russians are just flooding the world with oil, and it's kind of like, America and Russia are like, we're not friends, but what are we doing? We're doing the same thing. First, the American shale flooded the world with oil, and the Saudis were out of control, and now the Russians are doing the same thing. The Russians want dollars or whatever they get, rupees, to sell oil for their war and for their war economy. And the Saudis want to keep oil prices high so they can, diversify away from oil. And so it's interesting is that now the key point is these two major oil exporters are not on the same page anymore. And they were before, and OPEC is now diverging, pulling apart. That is deflationary. It continues to be a narrative here where this commodity super cycle just isn't happening. And that again is positive for inflation. I'm just looking over my notes. Let's take a real quick look here at some of the other things here. In particular, MT Brett. This is always a useful one. It is interesting to see here more stocks hitting 52-week lows today. Let's actually take a really quick look and see who those guys are. Let's just reload the S&P because there might be new members. But what's interesting here also is that, we have used this. In fact, if you look the 3 data crossover strategy, remember, this has been a pretty this thing has worked. We're getting near here an actual sort of a crossover of these two. So it's kind of interesting. Today, the difference between the two is this is the number of companies above the 20-day versus above the 50-day. And we've talked about this as being a strategy, and we've back tested it. This is using proprietary TradeStation data, the number of companies in the S&P. And this is actually something I discovered. And I've turned into a strategy, and we've been able to back test it and show that it really does work. Look at some of these longs that I identified at different points. It had some bad, like a bad one there and a bad one there, but it has caught some interesting moves. And basically it's been sitting and waiting here, but we're getting near a cross again because we now have a difference of 10. And yesterday the difference was 50. It was like over 20, like 25 or something. So this is a number of companies, above the moving averages. And this is now, if the market stays here, this could cross and flick bullish pretty soon. So this is actually kind of interesting. That's MT breadth. So the breadth has worsened because everything's focused on big tech. Let's see the companies that are actually at the 52-week lows. We can do that with our price grid. And we look at companies here, distance from 52-week high. And we can actually see these are some of the worst ones here. Companies like Dish Network, Catalent. Well, this thing is some disaster of a stock. But most of these are just a bunch of random stocks that are just kind of, and you look at these, I mean, who cares about Newell, Paramount? I mean, who cares about Paramount? These are companies now that are just a real quick thing we can do is we can just go to studies, add study, market cap. And the key thing is the companies that are doing poorly now are not important companies. So in many ways, I think people have to remember that basically when the market crashed, breadth got better because a bunch of random small companies did well. And now we have just the opposite. So I'm not concerned about breadth. I don't think technically this indicator is really working anymore. To me, it's just not as important. The advanced decline line is falling here. But I'll tell you, I have just not found this breadth. I mean, I think it's a great chart. I love looking at it, but I have not found it to be very useful recently. The thing I have found useful is looking at levels like 4,100 holding, 4050 holds, 4,100 holds, the 50% retracements. We held the 50% again and again and again, and we're stair stepping. Remember, these are monthly lows. That's the April low. This is the May low. And if you look at this if you look at the monthly chart, let's go back to the S&P here. We go to the monthly chart. These months are just getting, very tight, and that is not, never short a dull market, as they say. And what's interesting here is, let's actually go to studies. Let's go to our show me. Let's go to outside bar. I always like to use, I don't like this purple because sometimes I don't see it very easily. I'm going to change the color to white, and I'm going to change the style to a cross, which I find easier to see, make it big, and boom. Oh, we now have an outside month. So it's kind of interesting. Look here at this point in February of 21. The market tried to break down, and it just stuffed the bears. Well, at this point, same thing. It tried to break down, and it couldn't. So let's just see. I don't know if it even has to be a bullish month. The key thing is this is just a pullback that has been bought, and that's how I see it. Excuse me. All right, those are the main things I wanted to kind of cover. We'll be off next week because of Memorial Day and stuff, and then we'll be back on June 8th. Hope everyone has a great, let me see. Do you think the new BRICS alliance could affect the Saudis negatively? I don't know. One thing I've learned from looking at the market over the years is big announcements sound nice and politicians love to make them, but the big thing are just the underlying trends that matter. And I think the underlying trend is that China is sinking. It has too much debt and not enough growth, and they are going to export deflation, and they are not going to buy a lot of oil. And Russia is basically taking over the global oil market. And there's been an interesting sort of realignment of Russia and India. Now, if you look back way back in the 50s, these guys were allies during the Cold War. A lot of people forget that India was our enemy during the Cold War and Pakistan was our ally. I don't know if India was our enemy, but that America historically was aligned with Pakistan and Russia was aligned with India. So these guys have a long history. And for Russia now to become a global strategic partner with India, it has a precedent. And they are basically flooding the world with oil, and they are taking market share from the Saudis. So I think that is something that is really what matters here. I think this whole BRIC thing is kind of silly because the problem is all these are exporting countries, so none of them can create a global reserve currency. The idea that anyone is going to use any of these currencies as global reserve currency, I think, is not very likely. There's too many problems with all of them. You know, Brazil, I mean, none of them, I think, really have a lot of credibility. The idea of the dollar losing its reserve status, I think, is, it's people, this is clickbait of people trying to sell you stuff and reading Zero Hedge and things, which, has a few good things, but a lot of crazy stuff too. So that's how I think about it. Hope everyone has a great day, great Memorial Day. And we'll talk again in 2 weeks. Take care.